That's exactly right. What we're seeing from an underlying growth perspective in earnings season so far is year-over-year growth of 12%. And we're seeing surprises above average. Now, what you're also seeing is a little bit more volatility and dispersion under the hood. And when you think about earnings season, and you also think about the macroeconomic environment right now, what that means to us is the focus on quality, focusing on companies that have strong free cash flows, low debt on the balance sheet. Those are the companies that you want to be focusing on. And this volatility actually has created a lot of dispersion where many of these higher quality companies are now trading at more reasonable valuations given the volatility we've seen not just over the past week, but really over the past several months.
In a lot of ways, this volatility has been very welcome for what has been increasingly becoming a stock picker's market. Mm-hmm. But at the end of the day, over the next couple of months, what is going to steal the story? Is it the macro? Is it these positioning level kind of swings here that are sweeping up all of these names? Or is it the fundamentals?
So I think that's a valid question, and it's one that we're all grappling with at this point in time right now. I think over the next couple of months, you will see volatility, whether it's positioning, whether it's macro, whether it's earnings. But at the end of the day, we are investing for the long term. We're guiding our clients to invest for the long term. So what that means is stock prices trade on fundamentals and earnings growth over the long run. So while we might see some volatility, at the end of the day, the underlying earnings growth of the entire stock market is strong. Indeed, actually, by the time we hit fall and we enter 3Q earnings season, less than 5% of the S&P 500 sectors are going to be experiencing earnings recessions versus 70% 2 years ago. So while the market seems to be focusing on whether or not the economy is going to enter a recession, the reality is that many sectors within the market have already experienced their recession.
Yeah, of course. I mean, it seems so silly, right? What has changed if the market narrative before last, let's say, Wednesday was these mega cap tech stocks are riding the AI wave and it's going to boost the S&P 500 6,000. So, okay, we get the Japanese carry trade being unwound. That's pretty much done. We get the economy slowing down on a weaker labor market. You knew that was going to happen. The Fed raised rates 550 basis points in a year, right? Now we're going to get the cuts that we expected as well, maybe a little bit more. So can't we still be bullish, especially since earnings are beating expectations?
Yes, I think the bottom line, if you take anything away from this conversation, is yes, I think that even if there's volatility in the near term, we are constructive on equity markets moving forward for the fundamental reasons that I alluded to before. But selectivity is key. The biggest. Oh, please.
I'm always being the bear to Matt's bull right now. But, you think about that 5% of the S&P 500 really facing that earnings recession into the third quarter. What is that 5% looking like? To the extent that investors have to avoid at least pockets of the market, where are the places to avoid?
So I think the biggest thing at this point in time is we are advocating for clients to avoid the areas where a lot of the earnings growth has been driven by leverage. So anything that has a company with high debt on the balance sheet, that is an area where we're concerned about moving forward, because even as rates come down, the concern about what economic growth is going to mean and whether or not they're going to need to be dependent on capital markets for financing, that gives us concern. However, where is there opportunity? And that, I think, is what is so exciting. So we're seeing opportunity within pockets of tech. The biggest thing that I like to remind people is that the S&P 500 tech sector is up 14% so far this year. However, if you stripped out one company, NVIDIA, the tech sector is actually only up 2.5%. So we believe that there's an opportunity from a broadening perspective within the tech sector. And even outside of that, U.S. equity markets over the past year and a half, 60% of the returns that we've seen in the S&P 500 have been driven by these Magnificent Seven, these mega cap tech names. As we start to see more of these underlying companies within the S&P 500 go from earnings recession to earnings recovery, we think that there's an opportunity in broadening of the rally within U.S. large cap equities, and particularly within parts of the tech.
So you don't want to get too broad. I mean, you're not selling your NVIDIA and buying Russell 2000. You're just looking for, you might as well just buy the Qs, right?
So the biggest thing that I would mention there is even within the Qs, there's a lot of concentration within the mega cap tech space. Now, that selectivity is key. Your exact point is valid. You want to ensure that you're having access to parts of the market where the quality is high and where the competitive advantages are growing. And right now, what we've seen in terms of the Qs and in broader is that artificial intelligence is what has been driving the market so far. And a lot of that value has accrued primarily to semiconductor companies. Now, when we think about what prospects will look like moving forward, AI is not going anywhere. I think we can all agree on that. But there are parts of the value chain that have not accrued to the same extent.
How concerned are you to that end about concentration risk at this point still in the market?
So it's something that we're vigilant about always. I think that concentration levels that we've seen within the S&P 500 have reached the highest levels that we've seen in many, many years now. So while concern maybe is not the word that I would say, we're definitely observing it and we're cognizant of it. And in that way, we think that there are opportunities moving forward in areas outside of that concentration. And the biggest thing that I'll mention maybe is that concentration would worry me if the underlying fundamentals of those companies were deteriorating or if they were highly indebted or unprofitable. Now, that is not what we're seeing in these mega cap tech names now. Strong balance sheets, high free cash flow generation, strong margin. So when we think about equity markets moving forward, we're still constructive on that space. It's just when we think about the opportunity set and the incremental opportunity set, broadening is where we're very constructive on.